Denison Mines Corp, traded under the ticker DNN on the NYSE American and DML on the Toronto Stock Exchange, is a uranium development and exploration company focused primarily on the Athabasca Basin in Saskatchewan, Canada. The company is entering a major transformation period because its flagship Phoenix uranium project at Wheeler River has now moved from the development stage into full-scale construction. Denison received the required federal regulatory approval in February 2026 and subsequently made the final investment decision to proceed with construction. This changes the investment story significantly because Denison is moving closer to becoming a uranium producer rather than remaining primarily a developer. The central investment thesis behind Denison Mines is its exposure to the future production and cash flow potential of Phoenix. Unlike established uranium producers, Denison is not currently valued primarily on large recurring mining earnings. Instead, investors are assigning value to the future economics of Phoenix and the company's broader uranium portfolio. The company is targeting first production around mid-2028, which means 2026 and 2027 are critical construction and de-risking years. If construction remains on schedule, project costs remain controlled, and uranium prices stay supportive, the market could progressively revalue DNN as it gets closer to production. Phoenix is the centerpiece of Denison's entire investment case. The project is part of the Wheeler River property in Saskatchewan, where Denison has a 95% interest. Phoenix is designed as an in situ recovery, or ISR, uranium operation, which is particularly interesting because ISR can potentially provide a lower cost and less capital-intensive mining approach compared with traditional underground mining methods. After receiving regulatory approval and making its final investment decision, Denison began moving into full-scale construction. This means investors can now evaluate actual construction progress rather than relying entirely on feasibility studies and future development plans. The reason Phoenix is so important is its potential combination of high-grade uranium resources, attractive operating economics, and the ISR development method. The project has been designed around an operation that could potentially generate strong margins in a supportive uranium price environment. Denison has also incorporated contingency and owner's reserves into its updated capital planning. For investors, the key issue is not simply whether Phoenix contains valuable uranium, but whether Denison can convert that resource into production within the expected timeline and budget. If the company succeeds, Phoenix could fundamentally change Denison's revenue and earnings profile. The long-term uranium market is another major part of the DNN thesis. Nuclear power is receiving increasing attention as countries look for reliable electricity generation while attempting to reduce carbon emissions. At the same time, rising electricity consumption from data centers, artificial intelligence infrastructure, and industrial electrification could support long-term demand for nuclear energy. However, uranium prices can be volatile, and the market can change significantly depending on mine supply, reactor demand, inventories, and geopolitical developments. Denison therefore provides investors with substantial leverage to the uranium cycle, but that leverage works in both directions. One of Denison's advantages during the Phoenix construction period is its physical uranium inventory. Rather than relying entirely on external financing, the company can monetize uranium holdings to generate cash for development activities. During 2026, Denison sold significant quantities of U-308 at attractive prices, generating more than $90 million in gross proceeds from one 750,000 pound transaction. This is strategically important because it gives the company an additional funding source while uranium prices remain relatively strong. However, selling uranium today also means giving up potential future upside if uranium prices rise substantially higher. Construction progress is now one of the most important indicators for DNN shareholders. Denison has moved beyond preliminary site preparation and into full-scale construction activities at Phoenix. During the second quarter of 2026, the company reported meaningful progress in civil construction, with more than 20% of overall site civil work completed. Work has also progressed on the process plant, wellfield areas, and other infrastructure required for the ISR operation. Every successful construction milestone reduces some of the uncertainty surrounding Phoenix and should gradually increase investor confidence in the company's mid-2028 production target. Denison's financial position needs to be viewed differently from that of a mature uranium producer because the company is currently in a capital investment phase. Investors should not focus only on quarterly earnings or EPS. The more important metrics are liquidity, project spending, uranium inventory sales, financing requirements, and construction costs. The company needs to maintain sufficient liquidity to complete Phoenix while avoiding excessive shareholder dilution. If management can successfully combine existing cash, uranium sales, and other funding sources to finance construction, the company's long-term equity story becomes considerably stronger. For 2026, I would expect Denison to remain primarily focused on construction rather than profitability. The company is spending money today to create a future-producing uranium asset. Therefore, negative or relatively weak near-term earnings should not automatically be interpreted as a deterioration in the underlying investment thesis. Instead, investors should monitor whether capital spending is tracking against expectations and whether the construction schedule remains intact. The most important question for 2026 is whether Denison is successfully converting capital into tangible progress at Phoenix. 2027 could be even more important than 2026 because Phoenix should be substantially further along in construction. By that point, investors should have greater visibility into the project's remaining capital requirements, construction schedule, and expected path toward commissioning. If Denison continues hitting milestones, the market could begin assigning a higher probability to future production and cash flow. This could create multiple expansion even before the company generates meaningful production revenue. In other words, 2027 could be the year when DNN begins transitioning in investors' minds from a development company into a future uranium producer. In the bull case, uranium prices remain elevated, Phoenix construction stays on schedule, capital costs remain under control, and Denison successfully funds the remaining construction requirements without excessive dilution. Under this scenario, investors could begin valuing Denison based on the future cash flow potential of Phoenix rather than its current development stage financial statements. Strong uranium prices combined with successful construction execution could produce significant upside. In this environment, a 2027 valuation around the $6 to $8 per share range becomes a reasonable aggressive scenario, although it would depend heavily on uranium prices and market sentiment. My base case assumes Phoenix continues progressing toward production, but the market remains cautious because the company has not yet reached commercial production. Uranium prices remain supportive. Construction proceeds without a major disruption and Denison manages its financing requirements effectively. Under this scenario, I believe DNN could gradually move toward the $3.50 to $5 per share range during the 2026-2027 period. This would represent a meaningful re-rating while still recognizing that Phoenix has not yet reached the production stage. The bear case is primarily driven by execution and commodity price risk. If Phoenix experiences major delays, cost overruns, or technical problems, the market could significantly reduce the value assigned to the project. A sharp decline in uranium prices would create additional pressure because the future economics of Phoenix would become less attractive, while Denison would still need to spend substantial capital to complete construction. Under a severe bearish scenario, DNN could fall toward approximately $1.50 to $2.50 per share. This demonstrates why Denison should be considered a high-risk investment rather than a defensive mining stock. The biggest potential catalysts for DNN are continued Phoenix construction progress, successful completion of major infrastructure and wellfield activities, additional clarity around project financing, and sustained strength in uranium prices. Another important catalyst would be evidence that the company remains on schedule for first production around mid-2028. As each major construction milestone is completed, the probability of successful project delivery should increase. If the uranium market simultaneously remains strong, Denison could receive a double benefit from both project de-risking and commodity price appreciation. The biggest risk is construction execution. Large mining projects can experience delays, inflation, and unexpected technical challenges. The second major risk is uranium price volatility, because the economic value of Phoenix is highly sensitive to the uranium market. Financing and potential shareholder dilution are also important risks if construction costs exceed available resources. There is also technical risk associated with developing a large ISR uranium operation. Finally, DNN is likely to remain a highly volatile stock because investor sentiment toward uranium companies can change rapidly even when the underlying project has not materially changed. For valuation, I would avoid relying on a single precise number because Phoenix is still under construction and Denison's future cash flows depend heavily on uranium prices. Instead, a scenario-based approach makes more sense. The bear case is approximately $1.50 to $2.50. The base case is approximately $3.50 to $5, and the bull case is approximately $6 to $8. These ranges are designed to reflect different combinations of uranium prices, construction execution, financing, and investor sentiment. As Phoenix gets closer to production, a traditional NAV, or DCF valuation, should become increasingly useful because future operating cash flows will become easier to estimate. Overall, Denison Mines is one of the more interesting speculative uranium investments for the 2026-2027 period. The company has a major catalyst in Phoenix, exposure to the Athabasca Basin, and a clear path toward potential production around mid-2028. The biggest strength is that Phoenix has now entered full-scale construction, meaning the project is becoming increasingly tangible. The biggest weakness is that investors still face construction, financing, technical, and uranium price risks. My overall rating is speculative buy for investors who understand the volatility and are willing to accept development stage risk. The core thesis is simple. Phoenix is the asset, uranium prices are the macro driver, and construction execution will determine whether Denison can unlock the value investors are anticipating.